Good afternoon, everybody, and thank you for joining us in this third webinar in our series of Dunstan Thomas webinars, a SSAS market review, fixing the roof while the sun is still shining. Thanks also to everyone who's pre-submitted questions, which we've added to the Ask a Question tool. And please do submit more questions as we go and vote for the questions you'd most like to hear our panelists grapple with. The event is being recorded, so if you come back to this webpage 5 or 10 minutes after the event, the recording will be there for you to replay. Now, we're delighted to have three experts on the panel for today's debate, and to introduce them, I'll pass over to our chair for the session, Adrian Boulding, who many of you will know, but for those who don't, Adrian is a pensions actuary with a wide range of experience, including actually responsibility for a book of SSAS schemes in the early days of the SSAS market. For the last 5 years, Adrian's been a director of retirement strategy at Dunstan Thomas, where his role has been to keep Dunstan Thomas at the forefront of pensions developments. And he has other roles in the pensions market at Spire Platform Solutions, PS LSA, and Now Pensions. And he's currently a member of the newly formed pensions industry Small Pots Coordination Group. So, Adrian, may I hand over to you to chair the event?
Brian, thank you very much, and good afternoon, everybody. We've got 90 people. Oh, 91, another one has just joined. Fabulous, great numbers. So thank you all very much for coming. As Brian says, we've got an expert panel today to look at the SSAS market. Our experts are Claire Trott, who is chair of AMPS and head of pension strategy at Technical Connection. Claire has over 20 years of experience in the pensions industry. Her career has ranged from being a financial advisor dealing with pension transfers to helping advisors deal with the complexity of SIPs and SSASs in a post-simplification environment. In addition, Claire is chairperson of the Association of Member-Directed Pension Schemes, or AMPS, the trade association representing SIP and SSAS members, and Claire's role with Technical Connection continues to build on her ability to communicate with various audiences using a wide array of media. Our second expert today is Nathan Bridges, co-founder and director of Westbridge Group. Nathan co-founded Westbridge Group in 2020, so that's last year, with over 20 years of commercial experience in SSAS and specialist pension solutions, including 9 years with Talbot and Muir SIP and SSAS as a partner, director, and co-owner of their trading and trustee companies. Most recently, Nathan spent 3 years as managing director of group distribution at Embark Rowan Moore, the largest SSAS provider in the UK. Nathan is a pensions expert holding the CAI G60 Advanced Pension Qualification and is a regular commentator in the press on SSAS. And our third expert today will be Ian Mccullum of YourSIP. Ian has over 20 years of experience in the financial services industry with a wealth of knowledge across a range of sectors, including retail banking, insurance, assurance, wealth management, and employee benefits. For the past year, Ian's focus has been on the specialist SIP and SSAS market. He has worked for some of the biggest names in the member-directed arena, concentrating on operations, technical, and compliance matters. Ian keeps abreast of regulatory developments and best practices in the industry, ensuring YourSIP complies with all legal and regulatory standards. We'll come to each of those three in a minute to do some introductory remarks, but just to set the scene, I wanted to remind you that our story today, of course, began in 1973, the year that Motorola launched their first mobile phone, the size and weight of a brick. Women were admitted to the London Stock Exchange for the first time. A pint of beer would set you back 14 pence. The Queen opened the new London Bridge. Legendary goalkeeper Gordon Banks retired. Britain fought a cod war against the Icelandic people. And Ted Heath introduced the 3-day week. While all of those now seem a distant history, the Finance Act 1973 allowed controlling directors to join an occupational pension scheme for the first time, and the SSAS was created explicitly for that purpose. Those who've been in SSAS since the early days will remember Joint Office Memorandum 58, which provided the main legislative guidance for SSASs until the 1990s. The high tax rates of the 1970s ensured an early success for SaaS. Basic rate of income tax was 33%. Those earning over £20,000 a year paid a top rate of 83%, with a further 15% unearned income surcharge potentially added to that. And corporation tax was an eye-watering 52%. But anyone who's worked with this little gem called SaaS will know that it's so much more than just a tax dodge, and its continuing success today serves to underline that. We really ought to try and find the 1 millionth member of SSASs, because according to my count, something approaching 1 million people have now been through SaaS, been SaaS members since that launch in 1973. Many, of course, having run the full course of accumulation, decumulation, and passing residual wealth on death on to the next family generation. Today, the assets invested in SaaS total around about £1/3 billion, with TPR data telling us there's 22,000 schemes and 65,000 members. You may wonder whether SaaS has been a winner or a loser during the COVID-19 pandemic. Is SaaS more Amazon or more Primark in its behavior? The answer to that was in media a year ago, when one of the leading SaaS providers reported an 8-fold increase in SaaS registrations in just the first 10 days of April 2020, with businesses attracted to the SaaS loan-back facility to help get them through lockdown. In particular, I'm now seeing SaaS providers facing up to the challenges and opportunities of new technology. You can't run your SaaS records out of a shoebox anymore. The levels of immediate response that technology provides in other markets mean that SaaS customers won't accept slow service. HMRC, with their Making Tax Digital initiative today, demand that tax matters are dealt with promptly, especially if you're paying them tax. And soon the pension dashboard will be requiring a fast return of information from SaaSs too. The need to invest in technology is driving consolidation in the SaaS market. Look at a table of the combined market share of the top 15 providers, and you will see that they are growing in market share as the long tail of small providers exit. Indeed, there are exit opportunities available to those that don't want to invest in up-to-date SaaS administration. Those books of SaaS schemes are valuable, and they will easily find a new home for any providers exiting the market. I'll now move us on, and I'll ask our panel each to make some introductory remarks, and then we will move to questions. So please do feel welcome to type your question into that Ask a Question box at the bottom of the screen. And indeed, if you go in that box, you can vote for the questions that other people have typed in so that we will answer the ones that are most popular. But moving on, round our panel, I'll come first to Claire. So Claire, could I invite you to make some introductory remarks, please?
Thank you very much, Adrian. It's so difficult to follow you with your enthusiasm that where to start. I'm going to start by disagreeing with you. I'm going to start initially by disagreeing with you with the number of schemes. Any of us who work in the pensions technical area, anyone who works in SaaS will know, obviously, with TPR, you're only registering things with more than one member, and that means that there is a massive untapped amount of SaaS out there that we just don't know about. And unfortunately, that big sort of cohort of SaaS out there are not being run to the standards of those people that would run that are on panel today, that would run them in a better way. I've always going on, and advisors probably get a bit bored of me going on about the fact that if you're going to have a pension scheme, you need a professional administrator and a professional trustees involved. And there is such a big group of SaaS out there that are being run by one-man bands, being run by company secretaries, being run by accountants, and even they may know or did know what they were doing back in the day, but we've seen so many changes. You go back to a SaaS that was around even just pre-A Day, and there's been lots of changes, and then all the changes on reporting, and Adrian touched on the sort of real-time reporting, and a lot of them are not even engaged in that or engaged in the managing pension schemes online services. So there's a lot of things in the SSAS area that we don't see, that we really need to sort of sweep up into the sort of, it's not regulated, but the more controlled environment that we are used to working in. I think SSAS is really strong at the moment. I think SSAS has remained a strong product because it's really useful for businesses if used appropriately. I've worked in SIP areas, I've worked in SSAS areas, I've worked with Nathan at Talbot and Muir, and when you've got that balance of is a SIP right, is a SSAS right, getting the right vehicle for pension savings for people is the most important thing, and then running it well is definitely the next important thing. So for me, the market is strong, but there's still a lot of people out there that need our help.
Brilliant. Thanks a lot, Claire. Let me move us on, and we will come next to Nathan.
Thank you very much, Adrian. Yeah, unsurprisingly, I agree with most of what Claire said there. I mean, we've seen obviously exponential growth quarter on quarter in our SSAS book, both from new scheme establishments and takeovers, partly driven by the loan back tool, which is very, very underused still, but also commercial property purchase, good quality commercial property opportunities that exist. We've also seen a lot of work where we're repairing SSASs, offering a SSAS surgery for old SSASs that have been maybe poorly administered or that need refreshing and bringing up to date. So we're doing a lot of that work as well. I still think SSASs are the most underused tax wrapper in pensions. I think SIPs have been vastly overused and over-recommended. So if someone's buying a property, if you've got a group in an owner-managed business where you've got 4 or 5 directors, setting up 4 or 5 SIPs is very, very expensive compared to setting up a SSAS. It also doesn't leave the opportunity to do a loan back open. And you've got 4 or 5 sets of conveyancing fees, arrangement fees if there's borrowing. So it's very costly. And from a reporting point of view, it's more complicated rather than having everything on one sheet of paper. There's lots of other reasons as well, but I see a lot of SIPs being brought, 4 or 5 SIPs being brought into a SSAS to simplify things and to reduce costs. So I think SSASs are still very much underused, and I think there's a huge job on the part of trustees and scheme administrators like ourselves to help educate. We run a SSAS masterclass to help educate accountants, advisors, and SSAS members as to what you can and can't do. And I think a distinction has to be made in the SSAS arena. I think Claire's alluded to it very well there. There's a huge difference between a scheme administrator like Ian and myself represent with a capital A that has 100% liability with both HMRC and with the pension regulator, the TPR, and those that are offering sort of consultancy practitioner services where they perhaps haven't got the skin in the game. And I'd very much like to see a move towards what we had originally, which was pensioner trustee status, where we have more accountability, which will also help to sort of safeguard consumers, SSAS members. And that's my bit.
Brilliant. Nathan, thank you very much. I'll move to the third of our expert panel for some introductory comments. Ian Mccullum, over to you.
Yeah, thanks, Adrian. Yeah, I think there is not only an opportunity for people to buy up the smaller SSAS administrators that are leaving the market. There's actually also a vast opportunity for some of the big houses that actually offer SSAS to offload it onto specialist SSAS providers. What we are seeing is we're seeing an increased regulation on regulated companies that have got SSASs, actually bringing their regulation up to a level that a SIP is regulated at. Now, of course, that's prudent, that's diligent to do. But what it actually does is it precludes experienced business directors from taking out a SSAS and actually enjoying some of the flexibilities that a SSAS can offer. I think I completely agree with Claire's comment. I think if you are running a SSAS, it is absolutely prevalent that you have an independent professional administrator. And the reason for that is we've seen in recent times company directors, even at the on massive names on the high street. BHS comes to mind with their director, who had, cavalier access to the pension scheme and mismanaged the pension funds, which eventually led to the dissolution of BHS, a company that's been on our high streets for decades. And what I would say is that it actually removes that burden of responsibility from the directors of companies to actually give it to an independent party to oversee a profession which they're not, wholly knowledgeable of. And that aside, I think even though the SIP companies that offer SSAS are actually bringing it up to a level of that sort of regulation, that isn't necessarily a bad thing. What we have seen in the market over times is people's consumer rights under the FCA deliberately being circumvented and removed, where they would never get an asset approved on a SIP. So they've actually circumvented that by setting up and establishing companies which have never traded. And, you've got people in these sort of schemes that should never have been in these schemes. And I think, there is an opportunity there for companies to right a wrong and offer these people solutions to move to a product that is more suitable for them.
Ian, thank you very much. I'm going to head us into the questions now. And there's one question which is coming out with, more votes than all of the others, and it's around the professionalism of trusteeship. Those of us that work in the wider pensions world will be aware that this is something that TPR have driven very strongly in recent years on larger pension schemes, producing a number of new consultations and codes trying to ramp up the professionalism of trustees of large occupational pension schemes. In each case, they've been careful to say this consultation is not aimed at SSAS trustees. But nevertheless, there is a question amongst the audience to say, is that where SSAS needs to go? Is that where we think the regulator will take us? Some of us will fondly remember the era of pensioner trustees that SSAS used to have. So a question, is there a need for a more professionalism around SSAS trustees, and can we see a regulatory requirement for some kind of professional trustee to be involved with each SSAS? I'll throw that one to our panel. Who's keen to have a bite at that one?
I know the other two will have comments, but I'll start if that's okay.
Lovely.
I think it's important to recognise that there's a difference between trustees of a SSAS and professional trustees of a SSAS, because to be a SSAS, all members must be trustees. So I think to impose regulations on all the trustees would be too far. That obviously wasn't where we were with pensioner trustees, and I think there should be some educational pieces for those people involved in SSAS generally, because my experience is if you're all just lay trustees, then the knowledge is obviously lacking, and there should be someone who is fit and proper and suitably qualified to be running the scheme. And that is there. HMRC say that, there should be someone who's fit and proper, and they should be taking suitable advice, but they don't necessarily push it to the point that you have to have a professional trustee. And I think in today's day and age, in the day and age of scams, then having a professional who's liable and basically herding the other trustees to do the right thing is really important. Whether or not we can go back to the days of pensioner trustees is a slightly different matter, because you've got all these little SSAS out there that we don't know about, and I don't think that TPR know about, and actually in some cases, because they're so old, HMRC aren't so sure that they know about them all, but they would be the ones who probably have the best records. So I'm in favour of professionals, as I've said before, but how that works and how it could be implemented is quite a complex area, and I think quite difficult.
Yeah, lovely. And Nathan or Ian, would you care to jump in on that?
Yeah, happy to. I think we need to move from a cottage industry into a profession, and it's important that we recognise that being a professional trustee, it is a profession. It's not enough to be industrial and have it as an industry either. And I think there should be responsibility and accountability with that. And that comes in a couple of ways. There should be a fit and proper test, certainly for new SSASs and for new independent professional trustees. And there should also be qualifications required. And largely those will be the qualifications that we probably had in place before A-Day. and you would then have accountability and personal ownership. And I think you would find that the amount of scams, spurious investments reduced as a result of that. So I'm all in favour of actually going back to pensioner trustee status. But as Claire quite rightly says, I think it would be difficult with some of the really old schemes and some of the one member schemes that are out there. But perhaps there could be something from here on in for new schemes in order to move towards more of a profession.
Lovely, thank you. Ian, would you favour a rule that came in for new schemes but didn't apply to old ones that were kind of grandfathered through somehow?
Yeah, possibly. I mean, I think if we actually look back in history as to how the FCA came to regulate SIPs, or even actually if you go back even further and when the FSA then was actually formed, years ago, I started in the industry when there was voluntary codes that people signed up to. You had the banking code, you had the mortgage code compliance board, you had the General Insurance Standards Council, and certainly where my mind goes is, no disrespect to the FCA, but they haven't really got a handle on SIPs. They've never really quite understood it. Now there have been mootings for a long time whether or not the FCA could take over SSAS regulation. I personally can't see it. I would be more geared towards there has to be more collaboration between HMRC, TPR, and possibly the FCA in terms of the advice aspect of recommending a SSAS. But I would be more inclined to bring out some form of council body for professional trustees that lay down standards that you have to adhere with. I mean, we've recently had Scam Smart, which is a pledge that you make. It's you are going to keep people aware of scams. You're going to advertise that they should be aware of scams. There almost ought to be some form of certification. But like Nathan says, trustees ought to be able to take. There are tools already available. We've got the trustee toolkit, which I would recommend anybody watching to do. But there are other exams out there. The Pensions Management Institute. I mean, certainly everyone always remembers the PFS and the Professional Finance Society, but certainly for trustees, I would be encouraging them to go down the PMI route, which concentrates more on the diligence of being a prudent trustee rather than the advisory aspect. But would I want a real? Yeah, I certainly think that it does need to move away from being a cottage industry. And I think a lot of the big providers need to ask themselves a question as to whether or not they actually want SSASs, and is this a good opportunity to actually offer consumers choice? We've seen the SIP market reduce dramatically in terms of competition, and certainly there needs to be more competition in the market for SSASs, but it has to be a professional body.
Ian, that's very well put. Thank you. I mean, I think clearly, an element that we've heard from the regulator from time to time is people say, well, these are company directors. They know what they're doing. No, they don't. They know what they're doing in their business, where clearly they are experts because they're directing a company in that business. Our business, which is pensions, they may well have no more than much of a clue about it. I'm going to move us on to our next question. And our next question is very topical. It is very much sort of a here and now a question. The Chancellor has frozen the lifetime allowance at £1.073 million until April 2026. And the questioner asks, what flexibility does a SSAS have when some of the older family members have reached their lifetime allowance, but the younger ones haven't? Who would like to take that one on for me? So we're looking at SSAS. Some of them are banging their heads against the lifetime allowance. Others have still got some comfortable way to go.
I've got strong opinions on this, but I don't know if the boys want to talk about it first.
I think we'll let you go first, Claire.
Oh, okay.
Come on, Claire, go for it.
I strongly don't believe in reallocation of investment growth. I don't believe in it because which is what we're talking about here, that well, I do know some providers do allow the flexibility to do, because in my opinion, the inherent value of an asset includes its future growth. And therefore, when you own an asset or you own the value of an asset, you are inherently the future growth belongs to you. So the reallocation of growth for me, it doesn't feel like it works. It's as we've seen where that's been done in the past, it's been stopped for some providers. I'm not aware of all the providers that do it. It's not something that I necessarily see on a day-to-day basis. But in my technical opinion, I wouldn't be advocating for anyone to do that because of the high risks of HMRC looking at it and saying basically this isn't the nature of the legislation, as we've seen them say in the past to various things. So I don't think that SSASs have any more flexibility in moving around assets or growth than any other products.
Yeah, Nathan, Ian, any crumbs of comfort to those older family members that have hit the ceiling, as it were? Ian, come for it.
Yeah, I mean, I don't have much to say on that. What I would say is I would agree with Claire. I think there has to be a distinction as to why the rules are there in the first place and whether or not there's a deliberate attempt and quite an aggressive attempt to avoid the rules. I think we are seeing this more and more. I think people used to call it over creative financial planning, and we are seeing a great deal of that. Value shifting as well. It's quite clear what the rules are on that. I don't really have an opinion on why the Chancellor's made this move. To be honest, I think we're in very, very strange times at the moment with the pandemic. What I would hasten to add is whether there is a possibility, whether they review the tax relief that people are actually receiving on contributions. They're going to have to recoup the money from the pandemic somehow, and pensions does always seem to be the football that gets kicked about whenever the revenue needs some more cash.
Thank you. Nathan, any comment on that, or shall I move to the next one?
I agree with a reallocation. We can call it allocation of future investment growth, but ultimately it's a reallocation, which is an unauthorized payment in a post-A-Day world. So totally agree that it's not in the spirit of the legislation. So it's kind of semantics and it's marketing to dress it up as anything other than what it actually is, which is reallocating from one member to another member, which is a tax charge.
Back. Martin's just commented in the chat. He says earmarking question mark, and that is a very valid point. That if you have an asset that's growing and creating income, so say a property that's creating income, you could earmark that asset to an individual. Should you document it appropriately, and then those who are at the lifetime allowance, in theory, you could earmark the cash. I'm still in favour of generally staying within your own risk profile for what you're investing in, but that is something that's not against any of the rules, and can be documented in that way to give the growth assets to those people who need the growth and the non-growth assets to those people that don't. So valid point by Martin.
Lovely. Thanks, Claire. Thanks, Martin, for that one. Okay, I'm going to shift us on again, and my next question is about property and the rules on what property you can and can't put inside a SSAS. We have heard some stories of companies that want to put a property into their pension plan, having to sort of go around several providers before they will find one that will take some of the more difficult ones. Are the HMRC rules on which types of property you can put inside a SSAS clear enough? Ian?
Yeah, so I think everyone wants a simple office block, don't they, with the sitting tenant and the regular rent coming in. I think what we are seeing is more complex transactions. But not even so much complex, but we're seeing a lot of shared ownership. And what a lot of people are not so keen on, especially perhaps the bigger SIP providers, they're not very keen on co-owning a property with perhaps another SSAS provider or another SIP provider or complete third parties. Now, it's a bit of a broad span, the word complex. I mean, it could be part of it's owned by a unit trust, or but most of the big companies now will want that simple property transaction. And I actually think this is where the smaller providers, smaller SIP and SSAS providers, can actually pick up some of the market. They've got a more bespoke service. They can offer that kind of flexibility. But I mean, commercial to residential property is quite a grey area. Now, HMRC's guidance is a bit woolly. It says, but definitely before the habitation certificate is issued. Now, The problem is that with commercial to residential, unless you've got somebody with a bespoke service managing that development, the scheme could inadvertently acquire residential property, and it is a bit of a grey area. Some providers say that the property must be sold before the roof is put on. Some say before the bathroom and the kitchens are installed. Some people are quite flexible. They'll say it's before the habitation certificate is issued. But the problem is, and I've seen cases in the past where the architect has applied for the habitation certificate and it's not actually been, the sale process hasn't even started at that stage. So the scheme has inadvertently acquired residential property. HMRC's rules, I think we've seen it recently with in-specie contributions, even when they're wrong. They will still get away with saying, well, it's just guidance, which does beg the question, should we actually be even relying on the pensions tax manual, considering, it was always determined that non-cash assets could be contributed to a pension scheme. Their guidance pretty much stated as much. And when they were challenged on it following the tribunal, they said, well, it's just guidance. We don't need to review our guidance. You should interpret it whatever way. And a lot of these things, even allocation of future growth, a lot of these things are based on guidance that's never actually been tested in law. And that's something that financial advisors wanting to be creative with certain transactions ought to be aware of, that sometimes the providers saying no, not because they don't want to do it or because they don't want to carry out your advice. They're doing it because they can see the risks. They're going with the historical things that have happened and the rules that have been put in place after they've bing tested.
Thanks, Ian. Nathan, have you had difficulties with particular types of property?
I think first thing to say is really every commercial property is different in terms of the actual building and structure and what is going to happen to that property and the tenant and its use now and its use going forward. We've done all sorts of weird and wonderful properties which are classed as commercial, from golf courses to Baptist churches to bluebell woods, orchards, fishing lakes, gravel pits, quarries, all kinds of things. And often SIP providers that have got a SSAS book and legacy providers where SSAS perhaps isn't their core business have turned them down because of not just pension tax manual rules or HMRC rules, but often because they're looking at their own risk rules, their own interpretation of the rules and their own appetite for risk management. But equally, if they've got if they've got a SIP book as well, they're looking at it as an owner of the property under their trust arrangement. Whereas in a SSAS, we've got a lot more flexibility to do things like restriction of title and to look at each case on its merits. So we have accepted things just on its own merits and its own rationale, but dealing with each case as an individual. And you have to do that with SSAS, and SSAS don't lend themselves to sort of a broad brush to say, as for example, all overseas commercial property is not acceptable. Some will be in the right jurisdictions with the right title, with the right controls and processes, like anything.
Thanks. Claire, is this something you see around the table at AMPS with some of your members saying, yes, we accept this type of property, and others saying, no, we don't touch that with a barge pole sort of thing?
Most definitely. And it is up to each individual provider to assess their own risks and assess their own specialities as well, because it is important that the trustees and those people getting involved in those transactions understand what they're doing. So if you don't have that specialism, then you're definitely right to turn it away. So we need to make sure that we're protecting the members. And protecting the members can mean, not doing what they want. And this is, again, back to the risks of if you haven't got a professional trustee to rein you back in. We've seen SSASs turn up and they bought residential because they just think it's being used for a commercial purpose, so it's perfectly fine. But because the reporting works, it doesn't necessarily get picked up or deemed unauthorized or deemed tangible movable property or taxable property. So there are lots of different stances, and I think that's a good thing for the market. Because people will have their niche and they will have the business that they do and it being appropriate for them, and then those people that don't want to do it don't have to do it. That's how a market works, and I think that's how it should continue.
Lovely, thanks, Claire. I'd like to move us on to another area which is really, really hot at the moment in the wider financial services market, which is around vulnerable customers. And clearly, as I said, SSAS has been going since 1973. So some of the people that are in SSAS today will be of advancing years. And of course, they have to be a trustee. So I really like to sort of chat to the panel about where we have people where their faculties are beginning to go. And we're beginning to get worried about whether they are up to trusteeship or not. Then what is it that we can do about that situation? What is it that we have to do by law? And in extremists, towards the end of faculties waning, can power of attorney help? And what particular classifications need to be added to a power of attorney to make it useful in helping somebody stay inside a SSAS? Who on my panel can I attempt into this one?
Yeah, I'm happy to
Ian,
go.
thank you.
Yeah. So I think that I've literally just done vulnerable client training with our staff here, and I think after reviewing the vulnerable client charter, there has to be a differentiation. The FCA don't want you to label clients as vulnerable. They want you to actually focus on the spectrum of risk and what they can actually be subjected to. Now, is it up to us to determine whether somebody's lost their faculties, or do we need to tell them? Now, the reason why I say that is we have members and member trustees who want to make the most outlandish decisions, which of course as a professional trustee we're not going to let them do. But at what point do you determine whether somebody's lost their faculties? And I have an elderly grandmother. She displays many signs of vulnerability, but if you actually class her as vulnerable, I think she might take something and knock you over the head with it. People. Power of attorney, yes. It's always a part of a good financial planning approach to consider if someone could be subject to Alzheimer's disease or some other illness that may affect their ability to make cognitive decisions. As trustees, however, I think what we have to do is we have to look out for the signs of vulnerability and make easements. I mean, as trustees, and it may sound harsh, but as trustees, you're not paid to be nice to the members. You're not paid to do everything that the members ask. You're paid to keep them right. And if you are recognising signs of vulnerability, as the professional trustee, I think you have hopefully the SSAS will have a chairperson that you can go to, or a financial advisor. You have to have these conversations. If they are making outlandish decisions or requests, it could be a sign of vulnerability, and there are ways and means that you can go about sorting that. I think the risk comes with lack of admission. People don't necessarily want to admit that perhaps they are suffering mentally, or that they're suffering from an illness. People do have a sense of pride about these kind of things. But I think as professional trustees, we can do more to make easements. Obviously, you can't change legislation and you can't change rules because someone's vulnerable, but you can adapt your processes to help vulnerable clients.
Thank you. Claire, can I press you on something like power of attorney? Does that help in SSAS?
I think in some cases it could help, but possibly in the short term. I mean, there are issues, and I'm not a legal expert. I'm definitely not an expert in power of attorneys, but my understanding is that sort of a normal lasting power of attorney may not be appropriate. Although with certain wording and changes, then it could help in the short term. And again, possibly a trustee power of attorney, again, could help in the short term to solve issues and tidy things up. And maybe even transfer out. And I mean, this is where the end issue comes, is because all members have to be trustees, and if you're not capable of being a trustee, you then the structure of the SSAS fails. So it's dealing with things in a sensible time frame to be able to keep the structure of the SSAS, or to disband the SSAS and wind it up and take it out, so that someone can make those financial decisions on behalf of an individual. And I think for each provider, their trust deed and rules, what's in place, the power of attorneys that are in place, probably all need review. because none of them are likely to be the same. And I think that's going to be a real struggle as we see people living longer, people retaining these really good schemes. But actually, when it comes to it, if you can't take instructions from all the trustees, which is what you should be doing, then is it still appropriate? And that's where it's really good to have a financial advisor, to have a chairperson, to have somebody to help drive that. Then it's really difficult to do it if you don't have that sort of person. So to me, your standard power of attorney, is unlikely to cover these issues. You're going to need to make changes to various documents and maybe put specialist details in place. But I say I'm no expert, and I would always urge people to get legal advice on those ones.
No, thank you for that. Nathan, from your experience, have you had difficulties sort of, removing people from SAS when they're no longer want to, be a trustee?
We have, yes, and I think there's a huge distinction here between sort of legacy books and those books that are very actively managed. And Claire mentioned a chairperson there. If you know your SSASs really well and know the members, and also if they're active SSASs, so often these are owner-managed family businesses. If you've got the next generation in there, that really does help because you're talking collectively for the good of everybody within the family. I think that really helps to have a handle on your schemes, and really knowing your client is a big help in that.
Thank you. Lovely. I've got another question which has come in, which has attracted a lot of votes, and that is, what are the major abuses that the panel have seen, both by SSASs, both with practitioners in play and the orphan SSASs? So if I could ask you to look at that, obviously, beware of client confidentiality. Don't mention client names, or don't mention them if it's so obvious who it would be. But are there abuses that you've seen that others of us can learn from by hearing about them? Ian.
Yeah, I have seen abuses. I would go back to one of the earlier questions about single member SSASs. I have seen cases where there's white van drivers, dinner ladies, all with a pattern of companies that have been set up specifically 2 or 3 months prior to the scheme establishment, never traded a day in their life, either in compulsory or voluntary strike-off, and all with one common thing, that the money's come in, they've taken PCLS and they've invested in some asset that they would never have been able to do on a SIP. Now, that abuse is actually a market abuse, in my view. There is a level of if not criminality, morality, because what they've actually done is they have removed and stripped that consumer of their retail rights, the rights that they would have under the FCA to have FOS look at a complaint, where TPO will look at the administration of a complaint, FOS will look at the sale and the proposition of that SAS. Other abuses where members, company directors have used the SAS bank account, going back to the professional trusteeship, where company directors have used the SAS bank account as a slush fund, as a second company bank account, shall we say, not realizing that they are actually running a pension scheme. But yeah, there's various market abuses, and I think this isn't. I'm not advertising here that this should be a yes, let's get regulated. But there certainly has to be more collusion, I would say, between the regulators and the revenue. Because what we are seeing as a result of those abuses is people being slapped with tax charges. I could name a specific asset, but I won't mention this particular asset. But there are these lay people, as I would call them, who didn't even realize. I mean, I remember one specific case where a member had a company's house letter and said, "Is this something to do with my pension scheme?" They'd never had a company. They didn't even know that they were a director of a company. This isn't so it's not a shout out that I want harder regulation. In fact, it's quite the contrary, but there has to be more collusion between the regulators that are actually in place to stop these market abuses.
Thank you. Nathan, if I could come to you, do you think that this sort of fraction between the regulators, we have both HMRC looking at this, TPR formally regulate the SSAS, many of the practitioners will be FCA regulated. Do you see abuses coming because they're sort of falling between the cracks between the three?
Yeah, I think so. I think it needs to be far more joined up. Agree with what Ian's just said there as well. But I do think as well, it does come back, the solution still comes back to pensioner trustee status to run a scheme to set a SSAS up.
Thank you. Claire, anything to add on this one? Or
I mean, we have seen, various, they're scams, in my opinion, in most of these cases. The people who are involved in them are generally unaware. But the crackdown on the dormant companies, I think, as Ian's mentioned, is really important. And I think that's actually put pay to a lot of this. And I think the market is stronger and SSASs are stronger because of it. The registration of SSAS now, yes, it's taking longer for those people who've been trying to register SSAS during the pandemic. There was long delays, and that has obviously caused a few problems, especially with the loan backs. But the reasoning behind a lot of that is the extra questions that are being asked when they're being set up. So I think there is something going on behind the scenes at HMRC to try and ensure that they're being set up for the right reasons and the right people are involved. But it's still probably not strong enough because we do have this disjoint, as Ian mentioned, that things can fall down between the cracks, which is always worrying because it's always the end consumer that suffers.
Lovely, thank you. If we could move on, and we've been asked to talk about customer service a bit. We know that service is moving forward and technology is moving forward in all walks of life, but looking at SSAS in particular, what should SSAS members be expecting from both their advisors and administrators? Nathan, can I come to you on that one?
Yeah, I think a lot of SSASs do need dragging into the 21st century with things like advisor client portals, so that clients can access their bank balances online. Obviously, only certain banks will be able to give those price feeds and to see that transaction history, and things like DocuSign and other online signatories, so that we don't have to, not everything's in a sort of quill pen or a big pen and a biro, a piece of paper. We do need to drag things into and automate where we can and have some element of sort of self-serve online. The SSASs don't lend themselves well to automation. They aren't. You can't put them in this sort of sausage machine and have straight through processing, because every SSAS is its own bespoke scheme. They are individual schemes. You're dealing with quite demanding business owners, company directors, who will want to tailor and bespoke their scheme. So they don't lend themselves, like the platform world and even like the SIP world, into a sort of digital automated service culture. SSASs work really, really well with smaller providers, whereby they have cradle to grave administration service, and an administrator that looks after, a dedicated administrator that looks after a portfolio of SSASs, and gets to know the SSAS members and the advisors that are attached to those SSASs. But yeah, there does need to be improvements where possible. Yeah.
Lovely, thank you. Ian, can I come to you? I mean, in 2021, what should those SSAS members be expecting from their administrators and advisors?
Well, they should be expecting for the professional administrator to keep them right and not do everything that they say. And as Claire mentioned earlier, and I think we've done it to death, this is almost where, and I've always been an advocate that if you have a SSAS, you ought to have a professional trustee. Now, what is the point in paying all those fees? If you want to run it yourself, run it yourself. That's your choice, and unfortunately that's the choice that you still have at the moment. What I would say is, in terms of automation, there will take a significant shift to be able to give live price feeds. I think it's completely impractical, not only for SSAS, but also for SIP in a lot of cases. And when I say SIPs, I don't mean the platform SIPs. What I'm talking about is what we would call a true SIP. because you're going to have a range of assets on there which aren't necessarily going to be valued on definitely aren't going to be valued on a daily basis. We've got property, unlisted shares. You've got overseas funds that can't be readily valued. You have third-party loans. You'll have a whole host of non-standard assets within these schemes. Now, I suppose this comes on to the pension dashboard, and I don't know whether I'm probably getting ahead, but it will work very, very well. I mean, it would work for me. I've got numerous GPPs that I should be amalgamating into one at some point, but it would be nice to see everything all on one page. But I think to digitalize SaaS books, I think it is impractical. I do agree with Nathan. There are certain assets within the SaaS that can be digitalized, subject to CDOL feeds, or bank feeds. But it's never going to be a full picture on a daily basis, and I think that's important that they realise that.
Lovely, thanks, Ian. Claire, can I come to you about what should a member be expecting from their SaaS administrator or advisor today?
I think it's important that the service that any provider in any walk of life is offering is clearly set out, because every SaaS provider I've dealt with has a different SLA. So their service levels that they're offering differ, and you pay for those services. And I think that's a really important point. So if they're offering online, or if they're offering, regular reports, or if they're offering that, they need to set it out, set their stall out, so the client understands what they're expecting. Quite often I'm dealing with an individual who's going, they haven't done this, they haven't done that. And the reason they haven't done it is because they're not paying for it. So you go to a provider, and if you want an annual full statement, full report, then that makes sure that's in the agreement. And I think that's where there is a lot of confusion. It's not just in the SaaS market; it's in various walks of life. We need to know what we're buying, and it needs to be documented. And then we've got the comeback for you're not doing your job, or you're doing your job and you're doing it well, and I know what I'm paying for. I think that's just really, really important that we're upfront, rather than we often see a menu of charges, but it doesn't always spell out what you're going to get for each thing.
Thank you for that. Now, my next question is very current, and it's very pragmatic, and it's about the fact that a lot of SaaSs have commercial property as investments. Those commercial properties pay rent, and in today's world where businesses have suffered a year of pandemic trading, many forced to lock down, many are in extreme financial distress, how should that SaaS react when its tenants come and ask it, can we have a rent reduction? Can we just have a rent-free period? Especially if there are some links between, who's in that property and the SaaS itself. Who would care to go? Ian, comment on rent relief for me.
Yes, this is something that we've had to deal with as a provider quite often, and I think where there has been a bit of a lack of you can never prepare for this global pandemic. It's something that we've never been through before, but there is a disparity with the rules here that sits uncomfortably with me, and it's the connected party rules. Now, all businesses, whether you're a hairdresser, whether you're a pub or a restaurant, you've had to close, and that's a fact. You're not going to have an income. You're not going to be able to keep up with, your revenue. Yes, there are grants available, but they're not going to cover everything that ordinarily you would be able to pay. Now, the disparity is that if you're an unconnected party and the member agrees, he can write off your rent for you. If he's worried about, if he knows that you've got a viable pub that does a roaring trade and it will do again, he's not going to want to lose you as a tenant. Or if it's a hairdresser that does a roaring trade that sits in a major high street, he's not going to want. So he may choose to write off the rent. But the hoops that a connected party has to go through during this pandemic, I think, there should have been some greater easement, I think, and some recognition that, yes, under ordinary circumstances, you have to perform the arm's length test and you have to be quite scrupulous about it. But if you know that a business has suffered massively as a result of the pandemic and has lost all of their trade, not just some or partly trading, but has had to close fully, I take the view that, yes, of course, with an accountant's letter, confirming, that the company doesn't have, a little hidden nest egg that they could rely on or anything along those lines. But I think a more pragmatic approach has to be taken, and in some cases there will be cases where it's almost is the stance that the company's almost got to be on the verge of bankruptcy and going under before you're willing to write off some rent for them, give them a break, give them a chance to get back on their feet. Or, not a lot of members will want to do that. Not a lot of members, we've had some members be quite adamant that they don't want to give any relief to their unconnected tenants, which we've had to gently encourage them that isn't exactly the right thing to do at this time. And you're going to have a host of this, but I do think that there should be some easement towards the connected party rules in these cases, where if we do, as trustees, as professional trustees, and we can defend the decision, we should be able to write off some rent, just as we would be able to do for an unconnected party. But I would limit it to, very extreme circumstances upon which I think everybody can agree, we're in at the moment.
Yeah. Nathan, have you been encountering SSASs with rent relief issues?
Yes, we have. Yeah, I haven't really got much to add to what Ian's just said there. I think that's absolutely spot on. We do need to be pragmatic, and we do need an easement of the rules.
Yeah. And Claire, any comments on this one?
Well, there were a few easements early in the pandemic for sort of rent holidays and things like that, and the hoops we had to jump through for connected parties. But as I say, as Ian was saying, when it comes to the looking back, should we be trying to recoup all that? Because we were obviously letting them basically store up a debt, which we wouldn't have been. We would have been chasing them and actively, hunting them down for their money. But I think it's the next stage now that we need to start considering whether or not, now we're getting back into normality, whatever normality is going to be, but now we're getting back into normality, consider the long-term impacts of those. Because as you say, you chase them, you take a business down that was a perfectly viable business. That is not what HMRC want to see, that's not what the government wants to see, and that's definitely not what the High Street wants to see. So I'm with Ian, and I'll raise that in the next HMRC meeting for you, Ian.
Excellent, thank you.
Lovely, thank you, Claire. Now we're coming towards the end of our time. I think we've got time to squeeze in one more question, and I've got one that's attracted a lot of votes on the board. So thank you very much, people, for sending in and voting on questions. And it's about dispute resolution. The question is, do we think that work is needed to create a proper dispute resolution system within SSAS schemes to make them more attractive to members and advisors, suggesting that perhaps individual SIPs are favoured because they keep things completely separate and so avoid any sort of risk of dispute? Do we have adequate dispute resolution facilities where the members of a SSAS are perhaps in tension with each other?
I'll go on that one if you like. Honestly, I don't think we do. We've seen cases where families fall out. We've seen cases where just business partners fall out, and they have differing recollections of meetings as well. So I think for administrators, I think it's really important, and trustees, it's really important to ensure that everything is appropriately documented and that there are get out clauses in the trustees. The sort of how do I get out of here if it all falls apart. So I think there is stuff that can be done when setting up a scheme, but trying to deal with that now for maybe a historic scheme where everyone's been happy is much more of an issue. Because it wasn't something that was really considered historically, but I think it's much more at the forefront of people's minds now when they're establishing new schemes. That is it? You say some people go down the SIP route just because they don't want to be in this position at the end of the day because they've seen it happen in the past. Right, Ian, I spoke over you.
Yeah, no, you're absolutely right. I think, in a very arbitrary world, I would say, well, the professional trustee ought to have the final words and that's it. But we know that it doesn't always work like that. I'm not going to bore you with how many cases I've seen of families in dispute. I think we'd be here all day. But I do think there has to be some form of dispute resolution. I would actually advocate, we're not judge, jury and, executioner. As a professional trustee, it's important that we don't take sides in the argument. I mean, I've had cases where 5 members have ganged up on one, and I've actually agreed with the one that they've ganged up on, so it puts us all in a very, very difficult position. You do get family members, but not even family members, business partners fall out, employees fall out with each other. the problem that we've got as professional trustees is we ought to be able to put in place some form of binding arbitration, where it's, like Claire says, incorporate it into the, you know, if you reach a point of impasse, then we will appoint, not you will have the choice to appoint, we will appoint as professional trustees an arbitrator, somebody to decide this case, and you will all be bound by it, and you will have no choice, because the problem that scheme administrators have got is the problems will go on for years and years and years. I can, you know, think of one particular case which has been going on since 2013, you know, because the family can't make a decision, they've all fallen out with each other. They can, whenever we think that we're somewhere, they're, you know, they throw another cog, you know, spanner in the cogs. But there has to be some form of absolute right for the professional trustee to take over this situation, not take sides, but to appoint an arbitrator.
Yeah, lovely. Thank you. Nathan, just quickly, a final comment on you, something useful way of sorting out disputes?
Yeah, I think the only thing I would add that before it should ever get to an arbitrator is when the property is being first proposed, just as important as buying the property, where all the focus seems to lie, is on the exit of the property, so that members are in agreement over who buys what in the event of, you know, death, in the event of no longer wanting their share of the property. So that a syndicated property agreement is in place on every scheme to start with, so it doesn't get to that point. It's not going to avoid it entirely, but it does help if everybody is in agreement at the very outset, and there's a focus on the exit as much as there is on the actual purchase and the acquisition of a commercial property.
Lovely. Nathan, thanks very much. Well, we've had an hour that has absolutely flown by, everyone. I'd like to conclude by firstly thanking our audience. 97 people have joined us today, which is testimony to the, you know, resurgence of interest that we are seeing in the SSAS market. This is a market with legs that's going to run and run. So thank you very much for coming, and thank you for the questions that you put up and for voting on the questions. I'd like also to thank our panel who've freely given their time today. That's Claire, Nathan, and Ian. So a big thank you very much to you. I'd like to put up a thank you too to Alex, who's done all the administration in the background completely unseen, and without whom we wouldn't have got here today. So thank you also to Alex. Now, we have a series of these webinars, as you probably know, at Dunstan Thomas. The next one in our series is on the theme of shaping income in retirement. And we'll be looking at how much retirement income do people actually need, how do those needs change during the duration of their retirement, and bearing in mind that most people have more than one pension plan or more than one asset that can generate some income in retirement, what are the pros and cons of taking the income you need in different orders from different assets? That webinar will be on noon on Wednesday, the 26th of May. Alex has kindly put the link to sign up to it into the chat box. If not, you'll find it on the Dunstan Thomas website, and I'm sure he'll send you an invitation as well. So I will hope soon to see you, many of you, again on Wednesday, 26th of May. And in the meantime, it simply falls to me to thank you again, the audience and panel, for coming, and to declare the event closed. Thank you very much.
Thanks for having us.
Thank you.
Bye, everyone.
Bye.